The balance sheet is a financial statement that presents a snapshot at a specific point in time of where capital that a company has raised has come from and what it is being used for within the company to create additional wealth. Every company from the moment of inception is engaged to raise money or capital so that it can invest it to create goods and services that they think society will want. At its simplest level, there are two methods that a company can use to raise money.
The first method is to borrow or take out a loan from a financial institution or issue pieces of paper called bonds or debt, upon which the company would pay back the debt plus an appropriate amount of interest until the loan is paid out. The second method is to find other investors, which could be individuals or other companies, who are looking to invest their own money and convince them that their company will be so successful in the future that they are willing to sell to them a percentage ownership in the business. This would allow the investor a right to a percentage of any future profits that are generated by the business. A company can facilitate this by issuing pieces of paper called stocks, with each stock representing a percentage ownership or equity in the company. These two sources of capital that are raised are represented on the balance sheet in two sections. Capital that has been raised from loans and issuance of debt is represented in a section called liabilities, while capital that is raised from selling ownership of a company is represented in a section called shareholders' equity.
So let's say, for example, that I determined I needed to raise $1,000 to start a business, and I was able to get $500 from taking out a bank loan and $500 from selling stock in the company. On the balance sheet, I would show the bank loan of $500 under an account called liabilities, and I would show the $500 of money that I raised from selling stock in an account called shareholders' equity. The total, the $100,000 that I raised, I would put in the bank, and on the balance sheet, it would be represented under an account called cash in the asset account, and that would represent $1,000. The money that is raised from the issuance of debt or equity is put in the bank and drawn from it to undertake many activities to develop and create products and services. These activities can include purchasing raw materials, purchasing new equipment, hiring labor, or building or leasing factories and office space. The allocations or uses of capital are reflected in the balance sheet under a section called assets. The company is hoping that these allocations of scarce capital that they have just raised will ultimately lead to the company selling goods and services that will create additional capital than what was initially raised and ultimately create more value in the company. So going back to my example, initially when I raised that $1,000, that money would have gone into the bank and would be shown on the balance sheet as an asset under the account cash. As I invest that $1,000 into buying materials and equipment and hiring people, that $1,000 in cash in that cash account will decrease and will be distributed to other accounts like inventory or property, plant, and equipment. What makes the balance sheet unique is that the sources of capital, in other words the liability and equity accounts, are always equal to the total amount of assets. As a company makes decisions to spend or invest its capital, the cash and asset wheels will expand and contract accordingly. At the same time, the equity section of the balance sheet will also adjust accordingly to keep things in balance. Liabilities are broken down by the period in which the amount borrowed is expected to be paid in full. Liabilities that are due within a year are itemized under the account called short-term liabilities, while liabilities that are due in more than a year are itemized under an account called long-term liabilities. The shareholders' equity account itemizes the monetary value of stock that has been issued, as well as the amount of money that has been generated from profits and retained within the company for either future investment into the operations of the company or to pay back the shareholders in the form of a dividend. A company's assets are also itemized and presented in a similar short-term, long-term format. Money that is sitting in the bank, or money that is owed to the company by customers or is used to invest and produce inventory is represented under the current or short-term assets accounts. While money that is invested for long-term uses, such as buying land or purchasing equipment or purchasing a building or leasing a building, is itemized under long-term assets. So, as investors, we are very interested in the balance sheet report because it provides a concise view of the quality and quantity of capital that has been invested in the company, and also to see whether that the money that has been raised is being managed and used effectively. The balance sheet also tells us the net worth of the company, which is simply subtracting the total liabilities from the total assets of the company. If the business is truly being managed well, the investment decisions that the company is making should translate into profits, and these profits would be represented in another type of financial statement called the income statement. Greater profits will increase the net worth of the company and ultimately increase the price of its stock. The profits could then be reinvested back into the company to create better products or services, or it can be paid back to the owners and investors of the company in a periodic payment called a dividend. The balance sheet is often ignored when companies are being analyzed. It's the income statement that gets all the attention. However, as we can see, it can provide a great deal of insight into how a company is being managed.